at JP Morgan as chief strategist. I wanted to create a company that was targeted to bring institutional grade research, but make it understandable for everybody. And the bet at the time was that in 2014, the public wasn't interested in stocks. You know, like trading was dominated by institutional.
Right.
Like retail trading volumes were dropping. But we said, you know what? I remembered in the 90s when people cared about stocks. I think that period's going to come back. So our bet was that people would have interest in what we had to say.
And what at that moment, because that's a hell of an argument to predict the Robinhood generation before that happened. What was there data at the time?
Well, actually, yes. So part of our evidence-based research is that we look at demographics. And so we've written many white papers about how things happen by generation. And what we had published, and actually we published this as a white paper, was that the millennials were the single largest ever generation. The total cohort size is 98 million births.
Right.
And that was like 40% larger than the generation prior.
Right.
And what happens if you look at by generation, you split to 20 years, every other generation cares about stocks because
embracing new media at the time also was a bit risky because social media was not like it is today back in 2014. Did that feel natural, or did that feel like this is a struggle to figure out how to communicate to the rest of the world?
Well, the first couple of years, I would say it was a little hard to find our voice. Like,
right.
You know, Twitter was 255 character max, and it wasn't as robust, you know, so like it was just almost pure text. So it'd be like, well, what do you say in 255 characters?
Right.
And people weren't threading back then. Like, you know, like, okay, I put my name, I put a price target, and then everyone's going to get upset if the stock goes down. And as you know, in the public domain, we're always judged by the success of our last call. So
correct.
Like, and in Twitter, there's people who never forget. So like, I would say the majority of our conversations on Twitter are people like yelling at us and screaming at us and saying how bad we are. And I think it's kind of funny. So I don't mind because I know it's just the nature of the platform, right?
Right. Well, you do a good job quote tweeting their tweets on the days where, you know, you're not really that wrong, which is more often than when you are wrong. And I think, you know, that does a good service to kind of communicate your message to the world. Okay, so let's get into some stuff around the markets that I think people will be interested in. Here's a tough one, or here's an easy one. Not tough at all, no pressure. Should Powell be cutting rates?
You know, as you know, I actually almost never comment on it, like my opinion on it. In fact, in our writings to our clients, because we have about 10,000 RIA clients and 300 hedge funds, but I do show them evidence, and then say like tariffs are going to create inflation this summer, so they're going to wait to cut.
Right.
We recently wrote about this to our clients, and I think we shared some on Twitter. Tariffs are actually a tax because the money goes to the government. Like, so in other words, imagine if like the U.S. government said, I'm going to tax gasoline with an extra $6 tax.
Right.
And then, CPI of gasoline jumps. The Fed's not going to raise rates because they'd be like, oh, people's wallets just got hit.
Right.
So we might actually cut because they're getting hit by paying this tax to the government, because the government gets the money and it goes back in the economy. So it's not inflation. It's just transferring the money. That's what a tariff is, right? Like someone pays it, goes to the government, goes back in the economy. That's not inflation. It's actually inflation. Like trueflation is better than CPI, for instance, right?
Do you think the way we calculate inflation, like the Bureau of Labor Statistics, the way we calculate JOLTS, like we got yesterday, 400,000 more jobs than expected, do you think these models are outdated in how they gather data?
Yeah, or they're a really imperfect representation of actually what's happening.
Right.
Because as you know, like the response rates matter, and there's like really weird CPI concepts. Like how they treat how do you treat technological innovation? Because that's deflationary, but they never treat it that way. And with regard to like JOLTS, it rarely syncs up. JOLTS response rate's like 40%. But it doesn't sync up to other data like lookup or McKinsey's. I think it was McKinsey cutting 10% of its workforce. I mean, government contracts and U.S. aid.
Right.
So it's not tariffs hitting the economy. It's Doge.
Do you think at all that AI was responsible for some of the services sector that got hit today?
It's possible. I mean, if it's less hiring, for sure. I mean, Salesforce today said half of their work is being done by AI. I mean, remarkable. Like saying it's always V-shaped.
Right.
So that was our bet. It's like, this is a growth scare because high yield wasn't reacting. So it was just the stock market reacting.
Right.
Now, a second thing that got people super bared up, our institutions, was, Tom, the Fed's not coming to the rescue. They said, the only reason markets rally is the Fed cuts rates and unleashes money. And actually, our argument was that's actually an illusion. So our belief was that you'd still get V-shaped even if the Fed didn't cut. But a lot of people were saying, look, the Fed said they're not going to cut.
Right.
So we're going to actually keep falling.
Right.
But instead we had the V-shaped recovery.
Why were you able to see that it is an illusion to think to depend on the Fed to bail you out?
Well, I think it is an illusion because when the Fed is adding liquidity, it's just giving the money to the banks.
Right.
So if the banks aren't lending, like that was happening like after 2008. They gave the money, the banks just built up reserves.
Right.
Like it wasn't sloshing around.
Correct.
So the more important money is actually retail. And that's guess, they actually argue for why a recession was starting. And as you know, economists went full on recession call.
That's correct.
So if you're a equity guy, how can you go stocks are going to do V-shaped when the economist of the firm just said there's a recession? So I think they got caught, and we're not having happy conversations with people.
Do you still think this is so you've articulated now that this is the beginning of a new bull market, and I imagine those institutional clients lose their mind when you say that. In a sort of nutshell, why is that the case?
Well, it's fact based because we had a drawdown of more than 20%, and then we made a new high. So like the weird math that like let's say a commodity trading advisor, a CTA
right,
has is that when you have a drawdown and then you make a new high, that date is the start of a bull market.
Huh.
So actually, like in the mind of the institution now, breaking 61.41 was a new bull market. But the real second question to that is, how many people fundamentally need the PE to be the basis for an investment? It's a shrinking universe, okay? Let me put it this way. Do you own a luxury watch?
I don't.
Okay. So let's say someone has or do you have any art or something, like a collectible?
Probably not, no.
Okay. Because remember, Tesla is scarce.
I have
right?
a Tesla, though.
Yeah. But see, okay, I mean, Tesla is scarce as art. Because name another company like Tesla. Like, there's electric car companies and robots, but in the world today, like go around the world, ask 8 billion people, is there another company like Tesla? We'll say, nope, there's only one Tesla.
Just one Tesla.
Okay, so that's a Da Vinci.
Wow.
Right? Think about that. It's like there's just one Tesla. And so then you say, pretend this is a Da Vinci, and like someone will say, I'm only going to value this based on the value of the wood and the string and the paper. And so the PE of this is actually 12 cents. But then like 100 people say, no, there's only one thing, equities, because they tokenized $1, right? And then now you're seeing, JP Morgan wants their own stablecoin, Amazon, Walmart, Goldman. Well, stablecoins are a great business model and they work really well for consumers and merchants, but they all have to operate on a blockchain.
Correct.
And the majority of stablecoin transactions take place on Ethereum. So Ethereum's been like kind of out of favor. It peaked at close to 5,000 several years ago, and it was stuck at like 1,400, 1,500. It's back to like 2,400. But stablecoins are only 250 billion today.
Correct.
It's 30% of the gas fees on Ethereum, and Ethereum mints more than 50% of all stablecoin creations. Treasury Secretary Scott,
he loves them.
Yep. And he says he thinks it's a $2 trillion market, which is 10x increase. The U.S. government wants more stablecoins because stablecoins collectively are the 12th largest holder of treasuries.
Correct.
And they're creating a lot of dollarization. 80% of stablecoin usage is outside the amount of Ethereum you have. And it maybe shrinks because they charge you fees. But these treasury companies, their goal is to grow the token held per share.
Right.
MicroStrategy, that's their benchmark, key performance metric. So One, if it trades at a premium to NAV, net asset value, they can issue stock and create more net asset value per share.
Right.
That's actually what they call reflexive growth. I don't think there's very few things in the equity world that are reflexive that way. Number two, because the underlying token is quite volatile. In fact, Ethereum has twice the delivered volatility of Bitcoin.
Correct.
If you held Ethereum an ETF, and you said, I want to leverage it and buy more Ethereum ETFs by borrowing money, the bank's going to charge you 10%. But if you're a treasury asset company, one, you're a corporation, so your cost of money is cheaper. But two, you can sell the volatility in the form of convertible or derivative, and then your cost of capital in MicroStrategy's case is zero.
Right.
So you got two levers to pull. The third lever you're pulling is that you have a market price to NAV, and you have an equity, and then there's other treasury companies outside, price to net asset value.
Correct.
And so if something's trading at NAV, price net asset value, and you're trading at 3 times, you could do mergers and buy other treasury companies. Not a good snapshot, but because last night I was in the office until almost 2, maybe 1 a.m. I got home at 2.
In meetings?
Yes, I've been in Zoom. I'm usually fully booked all day and on Zooms. And then I got up at 5:30 a.m. for CNBC. And as soon as I got to the office today, I've been in Zooms all day. Wow. So I think I'm heavily scheduled. But I do find time to comment on Twitter, especially all the haters.
And you do your own tweets, right?
Yes.
I mean, it looks like you do your own tweets.
I do. That's why
it keeps it authentic. Yeah.
Yeah. Actually, so this is really important. I have plenty of people that offer to write things for me or research or the tweets, but I was like, you know what? I don't want someone to think that came from me.
Correct.
It has to come from me. So even our research, like I create a video every day for our clients.
Right.
It's about a 10-minute video, 5-minute video. And I do that. And I think it's important that I'm speaking to people directly. So research is a lot of work. I mean, that's why my hours are crazy. But of course, I have to talk to a lot of people and we have to do a lot of research. And we're doing research by calling people.
Like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.